Hi guys, this is Akbar and Craig here with another market review update. Welcome back. Increasingly, more people realize that their sustainability concerns can be addressed through their investments. As more investors embark on the sustainable investing journey, learn what it is, why one pursues it, and how to do it, assets into sustainable funds will continue and investors will have more choices from which to construct sustainable investing portfolios.
Individuals, as well as institutions, are increasingly concerned about sustainability issues. A World Economic Forum survey from the fall of 2020 concluded that 79% of American respondents agreed with the following statements. I want the world to change significantly and become more sustainable and equitable rather than returning to how it was before the COVID-19 crisis. We take a look at the growth of investor interest in sustainable investing while answering some common questions about it.
What is sustainable investing? You may have heard various terms used to describe sustainable investing, socially responsible investing, ethical investing, impact investing, among others. Although each of these terms is relevant to specific financial industry actors, types of clients, investment strategies, or subsectors of activity, they fundamentally describe the same thing.
Investments made with the intention of generating a positive environmental, social, or governance, which is known as ESG, impact alongside a financial return.
Investors commonly use sustainable investing to pursue two overarching goals: to protect and enhance long-term financial value through addressing ESG risks, or investing in solutions to solve environmental and social challenges. To protect, enhance, or otherwise positively impact the long-term health of the environment or society through expressing ESG values.
Some examples of ESG issues that may be considered in an investment strategy include the environmental, greenhouse gas emissions, energy management, and water and wastewater management. Social, access and affordability, labor relations, and diversity and inclusion. Lastly is governance, compensation and benefits, data security, and supply chain management.
So why sustainable investing? Investors generally pursue sustainable investing strategies really for two reasons. Fortify long-term performance. ESG issues can have a material impact on investment returns. When poorly managed, they can introduce risk into investments. When well managed, they can produce financial benefits. Some investors consider ESG issues in their investment decision making to enhance long-term risk-adjusted returns. Others see financial return generating opportunity in investing in companies that produce solutions to environmental or social challenges. Number two is to express personal values. Some investors desire to help build a world based on positive ESG values, a sustainable world, and adopt investment strategies that align with those values.
However, that was very interesting. Sustainable investing implementation strategies. Investors typically reach these goals using any combination of three strategies. 1. Aligning. Aligning their values with their investments to minimize exposure to companies or industries whose businesses practice conflict with their personal convictions. 2. Integrating. Integrating ESG factors into investment decisions to identify and emphasize investments in companies or industries with positive ESG practices or that solve specific ESG challenges, and to limit exposure to those with poor ESG performance. Thirdly, engaging. Engaging with portfolio companies and fund managers to encourage investments in ESG performance and mitigate risk related to ESG and to improve financial systems.
Strong growth of U.S. sustainable funds. Sustainable investing mutual funds and exchange-traded funds, ETFs, continue to attract record flows from investors. ESG considerations are central to the investment process for these strategies, and this commitment is indicated in the Principal Investment Strategies section of their prospectus. As of December 31st, 2020, assets grew 69% from the year before to $256 billion through the 381 distinct options available, compared to 140 in 2009.
Wow, that's a lot of change in those few years.
Tremendous.
Sustainability performance of U.S. sustainable funds. In addition to assessing the investment performance of sustainable funds, it is also important to assess the sustainability performance of these funds and to evaluate whether they are doing what they claim to be doing.
Morningstar's sustainability rating, which is based on rolling up Sustainalytics company-level ESG ratings, can be used as a proxy to identify funds that consider ESG factors. About 3/4 of sustainable funds receive the highest ratings, as compared with only 1/3 of funds overall, illustrating significantly lower levels of ESG risk in their portfolios.
Sustainalytics is a hard word to pronounce.
That's a tough one.
Another important, although often overlooked aspect of sustainable investing is how a fund engages with companies it owns through means including proxy voting in order to provide impact beyond financial return. Often called active ownership or stewardship, shareholder resolutions on proxy ballots often address sustainability issues. Data from 2020 illustrated a mixed bag, with most sustainable funds voting in support of key ESG issues, with large passive funds opposing most of the key votes.
And in conclusion, investor interest in sustainable investing has grown significantly over the last couple of years, and we don't expect that momentum will slow down anytime soon. Strong performance from sustainable funds in 2020 certainly played a role, but we think investors' increased willingness to express their values through their investments may be a bigger part of the story, which is why we think the growth is, dare we say, sustainable.
So once again, thank you. And to learn more about what Proactive Wealth Strategies is doing with your ESG portfolios, feel free to call or email your financial advisor. Have a great day.